business, so this is full-time for me. So thanks for listening in, and I'm just going to go through this. A little bit about me. I mentioned I'm a retired realtor. I have 2 children, a mom, married to a realtor, so I know this fairly well. Hi. Oh, have a seat. I buy real estate for my own investment purpose. I wrote 2 books. One of the books are in front of you. If you want a book, it's here. So this one was just published last year. The first one has been on the best-selling list since 2000. It's for real estate investors. So if you want to learn more about taxes, I don't think this is a great offer, but I wanted to say if you want to learn more about taxes, you can follow me on social media. I don't think I get a lot of following because I'm talking a lot about taxes. So a lot of the stuff that you hear from me, you can just go into realestatetaxtips.ca. I think my email is also in the book, my website. A little bit of disclaimer to begin with. Like everything else that accountant and lawyers give, we are not responsible for anything we say. Everything is individual situation specific. So fair? So don't take my presentation and go to your accountant. So let's start off with top 10 tax deduction. I think Julio initially wanted me to talk about the accounting trend for realtors. And I will, let's just fly through all the slides, and I'll allocate like maybe 15-20 minutes for any Q&A if you have, because I think a lot of people would have Q&A, so questions. So general deductibility rule, top 10 tax deduction. So I do a lot of presentations at different real estate boards, the Toronto Real Estate Board, RAP, I've gone to Sarnia as well. I think I might have done one for Cambridge, I don't remember now. So we talked a lot about realtor deduction, and one thing, whether you're a realtor, real estate investor, the first thing that we need to understand is that the Income Tax Act allows us to deduct any expenses that you incur for the purpose of earning either property income or business income. As long as you're eligible to, as long as you have the logic behind incurring the expense and establish that cause and effect relationship between incurring the expense and earning the income. Your accountant or your bookkeepers are not going to be next to you every single day. So when you issue the payment, when you pay for an expense, if you think that you can establish that relationship, sometimes people go really far and stretching the rule a lot, but just use your common sense. If you think you can establish the cause and effect relationship, keep the receipts, because the receipts is the number one thing that you need to keep. Your bank statement, your credit card statements would not be sufficient if you ever get audited by CRA. Okay, and then the other thing is, I know since last couple years ago, realtors are allowed to incorporate, and a lot of us are not very clean in terms of our bookkeeping, as in like your credit card may still be in your name even though you incorporate it. So maybe you need to have a corporate credit card. And there are also rumors out there saying that the current legislation is not written very well, and there could be some situation like CRA could come after the realtors who are incorporated for reporting everything in the corporation. That is a valid argument. So it makes having the proper record a lot more important. So if you are doing transactions and charging people or being charged, make sure that it's being charged to the corporation. Your business is really operating under the corporation's name. So whoever that's on the invoice when you're being charged is very important. Okay. So bank statements won't work, credit card statements won't work. You will still keep the bank statements and credit card statements because you want to deduct the fees and interest and everything that's incurred on it. But make sure that you also keep the original receipts. Typically when people would ask me like, is it possible to keep copy, a picture of the receipt. A picture of the receipt is totally acceptable these days because of COVID. They just want you to upload everything. They don't want to deal with you at all, no paper. And you have to keep it for 7 years. I don't know how many of you also buy real estate, like invest in real estate. If you invest in real estate and eventually you will sell it, the purchase documents and all the capitalized expenses that you incur on the property that you purchase for investment, you have to keep it for until you sell the property, 7 years after you sell the property. So just so we're clear, just because you spend the money this year on renovation, doesn't mean that you just need to keep the receipt for 7 years. It should really be kept together with the purchase document of your property until you sell the property, and 7 years after until you sell the property.
Is that just if it's in the United States?
No.
Anywhere?
Here in Canada. And if you buy properties in the States, you're filing as a Canadian resident, so the same rule applies. So the top 10, the number 1 is music and entertainment. Music and entertainment has to be reasonable. Make sure that you write down the name of the person that you take out for the meals with. If you don't write down the name at the time when the meal happened, chances are you probably don't remember when you get audited 3 years down the road. So you have to write down the name. Just getting to the practice of writing down the name. Like I said, sometimes they only give you the receipt, the visa slips receipt. That's not sufficient. You actually need the original invoice detailing the meals. Write it down. Music and entertainment also includes, it's only 50% deductible, by the way. A lot of us know that, but what you don't know is LCBO, all the beer store receipts, they are also only 50% deductible. And it also goes with, right now, what's popular? Raptors and Leafs games, they're all 50% deductible. Now, if you buy a gift card, like a Starbucks gift card, or I don't know, a Longo gift card or LCBO gift card for your client as a gift, as a thank you gift, all those gift cards are also only 50% deductible. So if you're buying gift card, you may as well just buy Home Depot or Amazon because they are 100% deductible.
Why is that?
Yeah, so LCBO, meals, any restaurant gift cards, they are all considered meals and entertainment, and there was a court case on that.
But when you go out for dinner, you're with your client,
You're
so you
still
can understand the 50%. But if you gave somebody $100 gift certificate, why are you only getting credit for 50%?
I know there is no why.
CRA?
Yes. So there was actually, I think, a realtor that took the same argument to the court, and the court initially sided with the agent. So the lower court sided with the taxpayer, saying that like you didn't enjoy any of the meals, and because it's a gift card, so it should be 100% deductible. And then CRA fight against that court and appeal to the next level up, and the next court said yes, even though I agree with everything the lower court said, but the law says that anything that's music and entertainment is only 50% deductible. That's what is written literally, even though the objective is to allow for 100% for gift cards. It is unfortunate that the court, the legal document is written that way. Hi, have a seat.
Good morning, thank you.
Well, that's something I've learned already. I would have already claimed 100%.
Most people just claim 100%, and then wait until they come back and challenge you, right?
Oh my God.
But if next time you're spending money and you don't want them to ever come back and have a case against you, you may as well just choose Amazon. If I say choose Amazon, people fight, not fight with me. People don't like me picking Amazon. They think that Amazon is this big conglomerate, and they don't like it. I like Amazon because there is an email address that's already attached to it. You send it out, you know that that's a client, you don't even need to do much documentation. The email itself is already a documentation. So when you buy gift cards, you also need to document, just like news and entertainment, you need to document who you give the gift card to. So if you don't have that person, I have realtors who come to me. Some realtors, I'm not saying they are here, some realtors are really aggressive. They would come to me and say, hey, Cherry, I'm buying clothes, and I'll just buy Moore's gift card, and then I'll deduct it. You can deduct only the, remember the general deductibility rule that we mentioned? You can only deduct the expenses that you incur for the purpose of earning your income. So your clothes, unfortunately, it has already gone to court. So the argument doesn't work, and your clothes don't count toward that. And so his argument was that, well, I'm buying this gift card for my client. I don't know how likely you really buy a Moore's gift card to your client, but it doesn't really sit well. And if you ever get audited, you provide a list of client's name and you put someone's name next to the Moore's gift card per se. They more often than not, they ask for not just the name, they ask for the contact information. So they would say that I would randomly check and call. That's what they ask when you go through the audit. You like it or not, that's how it's worked. I'm just a messenger, don't hate me, okay? So as all the other events, if you take a client to Raptors or Leafs or any sports events, entertainment events, or even buying a movie pass, they are all 50% deductible, and you need to write down the person's name who received that. And that person, you better have a business reason to give those people a gift card. Does that make sense? Okay. Automobile expenses, you need, the number one thing that you need is your auto log when you claim automobile expenses. Auto log is important because whether you own your car, you claim the car in your prac or own it in your personal name, that log is the most important thing. Now, typically people use, most of the clients, let's just be realistic, most of the people that I work with do not have a log. I would say 80% of the time they don't have a log. So there are apps out there that would be helpful. You can use QuickBook Online. There is the app attached to QuickBook Online. You can just use it. Anyone else using an app? No?
I use QuickBook Online.
Yeah, so then there you go. QuickBook Online. Anyone? Mile IQ is the other popular one that I've seen that clients use. I mean, there are 20% of my clients that use it. Julio is one of them. But not a lot of people actually have a log. It's important to have a log. If you don't have a log, if you ever get audited, you have to go back to your calendar to recreate your log. Okay? It sucks, but that's what you have to do. And please don't tell your accountant that you don't have the log. You just need to ask your accountant, how much did I claim? And then go back and essentially go back to your calendar and recreate a log. So auto lease agreement is important. You can claim lease up to $850 a month, but it's not quite $850. And then you can, if you are buying a car, the finance charge, the interest expense can be deductible. Your car is deductible as well. People often come to me and ask if they should buy a car or lease a car. That really goes back to your particular situation. On my YouTube channel, there is a very popular YouTube video on buy versus lease. If you want to get more insight, gain more insight into buy versus lease, go to that YouTube video because it has like a spreadsheet and I do an analysis. The way that it's being deducted when it's claiming under a lease is straight line. So every month you have a lease payment of $600, then $600 is being deducted for the full year. If you have a 4-year lease, every single year the amounts of deduction would be more or less the same. If you are if you buy your car, then the car deduction is a little different. Car deduction, whether you buy a Porsche, that's $100,000, or you buy a Honda Odyssey. I have a Honda Odyssey. I drive a Honda Odyssey all the time. That's a $40,000 car. The maximum you can claim is $30,000 plus HST. So $33,900. You buy a Lexus for $70,000, it's still $33,900. You buy a Civic, which is $25,000, maybe $30,000, $25,000, then you can only claim $25,000. but it's capped at $33,900. Another thing about car is that if you are in the market to buy a car right now, they still have this incentive available. If you are buying electric vehicle, clean energy, as we know, our Prime Minister is really into this clean energy thing that doesn't really give us return economically. You would be eligible to claim up to $55,000 instead of $30,000. Remember, if you purchase a car, if you buy a Porsche, maximum you can claim is 30. But if you buy an EV, qualified brand new EV, cannot be a used one, you can claim up to $55,000. And the benefit of using this incentive is that the first year you can write off the entire $55,000. Whereas the $30,000 one, it has to be spread out over a number of years. Yes.
So if I buy an electric car, could it be a hybrid or does it have to be full electric? Is there a specification to it?
There are specifications. I don't remember. I did the research on it. I have a YouTube video on it. It's like a top 10 questions asked.
Okay.
Yeah, I often refer back to, when I first created the video, I often refer back to the subsidy page, but Tesla qualify for the deduction, but doesn't qualify for the subsidies anymore.
Okay.
So then, there are specific criteria. Usually it's the plug-in hybrid and full electric.
Okay.
So that's the G license plate usually.
Okay. Hybrid. Okay. That's good to know.
The other thing is that to get this, to be eligible to claim this, to take advantage of this extra deduction the first year, you have to, you cannot take any government subsidies. So they may give you the rebate, you cannot take that subsidy at all. Now, the last thing about claiming this is that people often come back and counter and say, hey, like they give you the big deduction. When you sell it, you will have to report it as income. It's true. Now, but then the thing is, it's the way that automobile expenses are being deducted is based on your business use mileage. So the amount that you would have to take it back into income is based on the car's particular business use of that particular year. So maybe you do like very little. That particular year, you use that vehicle, is the last year that you own it, you may use it for very little percentage for your business use. And then that would help minimize the amount that you would actually need to take it back to income. When you purchase car, whether it's electric or not, you should always put it in your name. So you may have a spouse and you may have 2 cars, but you can only claim the capital cost allowance if you own the vehicle. If you own it with your spouse, then 2 names on it, you can only claim half. Now, of course, you can claim whatever you want until they come in and audit you, but I'm just telling you what the best practice is and how to defend it, right? Things that are also available for deduction is gas, obviously, but you have to keep the gas receipts. Maintenance and repairs, they are important. They are often being used by CRA as corroborative evidence to support your auto log. Because you can create whatever auto log you want, but it has to be consistent with what your maintenance record shows. Because they always shows the odometer reading on there. Insurance, interest costs if you finance the purchase of the car. One of the questions that I get all the time is, hey, like if I borrow money to buy a Tesla, does it count for the extra incentive? Can you still deduct it? Yes, you can. Interest cost is also separate deduction.
What about tickets and, for example, hiring a lawyer to fight a ticket? Is that, are you able to submit that into a claim?
I think if you ever get audited, they will disallow it, but I would just put it through.
Okay.
It is, especially if the trip is for seeing a client.
Yeah.
Yeah, so you missed the first deduction. The deduction is making sure that you understand that there is a cause and effect relationship. And again, the auditors are just interpreter of the rules, right? So they really, it's not like you open up, okay, the ticket is eligible for deduction, so check mark. It's not like that. It's interpreting what the law says and their policy is. So if you're lucky, you get a good auditor that are easygoing, and if you have a really good cause and effect relationship story to tell, then they would give it to you. So that's also very important. Parking is only deductible if you incur the parking for your business. So your parking expense for taking your mom to Pearson, dropping her off, is not tax deductible. So at all. But 100% of your business parking is tax deductible. And obviously, because we talk about EV, electricity charges are tax deductible. Oh yeah, see? I reminded myself to mention my YouTube channel, the buy versus lease, and then there is a $28,000 Tesla thing here, right here. There's a lot of view on this video. People really like to save $28,000. So buy versus lease is this one, the one that I recommend. So you can go on and check it out. We talked about this. Now, brokerage fees.
Just one more question on the automobile, just for my agents. Don't you have to pick a number? Like, my accountant has told me to use 75% for my business and 25% for personal.
Great question. So
So
the
that they
first,
know.
first thing I mentioned is that you need to keep the auto lock.
Yes,
So the way that everyone is being asked to keep the auto lock is at the beginning of the year, January 1st or December 31st, you take a picture of your odometer. So there's the baseline. Let's say it's a brand new car, it's 300 kilometer on it. And then at the end of the year, you take another picture, because every year you take the same picture. So then that formed the base. Let's say by the end of the year is 20,300. So for the full year, you drove 20,000 kilometer.
yes.
This particular car. Now, so based on your auto log, when I say auto log, it tracks which trip you are incurring for business purpose. Now, let's say your auto log, it turns out to be, let's say it's 18,000 kilometer driven for business purpose.
Okay.
You have it documented. So it's 18,000 divided by 20,000. So that's the proration,
Okay.
which would be
90%.
90%. Then you multiply by all these expenses that I listed here, then they would be the actual amount that's deductible. Now your 75% is just a random number.
Yes,
We
but
won't,
that's what CRA, they usually leave you alone if you do that.
Yeah, what's a good number that we can
Yeah,
get?
exactly.
That's what they need
Raise
to do.
eyebrows.
there is no exact number. How many of you are part-time? Everyone's full-time here? Okay, so that's all your part-time. So then how many of you go to 100 kilometer out of where would you live to do deals? Yeah, so then there you go. Like, it's hard to have a rule of thumb to say, 75% for sure you're not gonna get audited.
I mean, I keep all those things that you say, but that's a lot of work for everybody to do. And, we're all busy people, so,
Yeah.
like for me, I've used that for a lot of years and they haven't really, come after me on that one.
Yeah, the funny part is that I just had this conversation earlier this week, talking to my my previous boss, who is now at MNP as a partner. I don't know if you guys know MNP. It's probably one of the largest accounting firm here, and he and I used to work for Deloitte together, and he's been telling me with personal tax return, there's a lot of stuff that you can put through and get away with. And I think for personal tax return in particular, you will a reasonable amount. There is no reasonable amount, but you're not claiming 100% of your vehicle. You're good. Now there is a reason why I mentioned 90%. If you purchase a vehicle, you have to pay HST, right? So that HST portion, if it is over 90% in your personal name, you can claim the $3,900 directly against your HST return. But if it's under 90%, then that HST would have to be claimed as part of your depreciation expense. So there's a slight benefit to using 90%, but 75% for sure is very safe. But at the end of the day, even though it's safe, if you ever get audited, knock on wood, you would never get audited, they would still want to go back to see the actual logbook.
Well, I don't think too many of my people would probably have a logbook. I think only 2 people put their hand up, right? I mean, I think you're all keeping your receipts for everything. And I think the most important thing you said is that sometimes, if you change your cars every couple of years, you've got when you bought the car, it's either got 0 or it's a used car. It's got a number on it. So after the first year, like I know I log about 20,000 miles, okay, is what I log. And I have some business up north, and so I use the 75%, keep everything.
Yep.
Last time the accountants don't even give me the receipts anymore, just give me what you spent on gas and this and that, and so it's cause it's gonna be mind boggling for people, I think, to, I mean, I've never used a log, and maybe I should have, but, I've never taught my people to use a log, so maybe this is a good thing to help people moving forward, but, the CR people are not very nice people, we all know that, so, but I think within, if you use a number that you're pretty comfortable with, like I would say if you're using 90% and your income is not that much, you're gonna get an audit, okay, so everything is in relative situation, so if you're kinda consistent, it's worked pretty well for me in 40 some odd years, so anyways.
Yeah, that's great insight. I think in personal tax return, if you're paying taxes, your risk is already lower. If you're asking for a refund automatically, it's a red flag, right? So brokerage fees, I think chances are, I'm just betting on this, is that the brokerage is using Lone Wolf as a system to manage commission checks and everything. What I found over the number of years is that this is a great system, but sometimes there's a variation when it comes down to preparing your T4A slip. So, like the gross commission revenue could be $10,000, say. The brokerage cut is $1,000. I'm just picking random number here. And then you net collect $9,000. There are brokerage out there that would put the $10,000 on the agent's T4A slip. Then there are brokerage out there that would put $9,000 on the brokerage slip. And then after the $9,000, there are still some fees being deducted. And then some brokerage would put the net amount. So because there is such a wide range, your accountant or whoever preparing your tax document may or may not know that there is such a wide range, and the reconciliation has to be done, because if the numbers don't add, then there is something wrong, right? Like you don't want to over-report your income, but you also need to do the reconciliation, and that's the reason why it's so important to provide this tax worksheet that would then go with your T4A that we use to prepare your tax return. Does that make sense? Yeah.
Just one more question. If you buy a $100,000 automobile and only $33,900 is allowable for depreciation, when you get to say the 3rd or 4th year, and you sell that $100,000 automobile for $50,000,
what's gonna happen?
do you pay tax on the difference?
0. That's it. $33,900 is how much you can pay. So it
So now
gets
you
a little
sold
bit
it for
more.
100. So you sold it for 50,000, and the depreciated value was 10,000.
Yes.
So there's a $40,000 differential.
There is no tax on it at all. But then you cannot keep writing off the 10,000. That's it.
Yes.
That class ends. Yeah. So it gets a little bit more complicated, to be fair. You're in that scenario. If you have a passenger vehicle, it's considered class 10.1. And the attribute of this class 10.1 according to CRA is that if you sell the vehicle the year after for a gain, there is no something called recapture tax. There is no recapture tax. But there is another class called class 10. Class 10 are for passenger vehicles that you purchase under the amount of 30,000. So if you sell it in the future, the sale price would be used to offset against that undepreciated amount. And so that's why it's not like, in your particular calculation, there is no tax, but if you purchase a vehicle that's less than $30,000, there may not be immediate tax, there could be immediate tax implication as well, depending on the situation.
Does the weight of the vehicle determine? I think if it was in the U.S., I know after a certain weight, it's 100% commercial vehicle. Like it's 100%. Is that
Majority, as far as I know, majority of the vehicle that realtors use, they are all, the weights don't count.
But do we have that?
I
Do
don't
we have
think
anything
so.
to do with the weight? No.
No, has
Okay.
nothing to do.
Okay.
I would say majority of them, CI would argue that it's passenger vehicle, especially because of the line of business you're in.
Yep.
Unless you have a different business, could be a towing company, then that's a different story.
No, but you get certain high-end cars that are over a certain weight, right? And I thought I read something about the weight. No. Okay.
All good? More questions?
Yes,
Usually
wait
automobile
for the
has a lot of
G-Wagon.
questions.
Huh?
I'll wait for my G-Wagon.
Yeah, I think those are under certain weights. So
Yeah.
right.
Yeah, the Mercedes.
4,000.
I was
Yeah.
thinking people buying
Me too.
a Ram, so.
Joking.
Yeah.
It's getting hot here. I thought it's cold outside. Okay, referral fees. I don't know if you guys do referral fees. There are many different ways to do referral fees. When I went to Edmonton to do the talk, apparently the province of Alberta required all referral fees to be done, referring back, like when I talk about referral fees are the fees that being paid back to the client directly. That referral fee has to be done through the brokerage directly. So then it may or may not even hit your T4A at all. So that would be the perfect way to do referral fees, because it will not even hit your bank account. You don't need additional documentation. It's totally legitimate because you're giving back the client the money. It has nothing to do with any illegal stuff. Now, if you are, that is the number one thing that you should do if you have an option to do it. Now, then you may ask the question, okay, then do the clients need to pay tax on the amount that they receive? Well, it depends. Even if they need to pay tax, I mean, you're giving them back some money, so they should really pay tax on it. But the reality is, if they are buying, you're helping them to buy or sell a primary residence, because primary residence sale is not taxable, generally speaking, the amount that they receive would not be taxable as well. On the other hand, if you're helping them to buy an investment property, if it is for long-term rental, the amount that you give them back would be used to reduce the purchase price of the property. So again, there is no immediate tax to pay. How it's going to affect them in that particular situation is, let's say the property is $500,000 and you're giving them like $5,000. So now their purchase price or adjusted cost base is $495,000. So 10 years from now they sell, it should really be $495,000. They should really use the $495,000 to calculate their capital gain. Does that make sense?
What LePage West has always done for a number of years now is that you may have a promise to a client, whether it's $1,000 for new appliance or something like that. You give us that piece of paper, and then we pay directly to the client, so
that's
that
awesome.
you're always clean. So
Yeah.
and the accounting always shows like referral, everything adds up to the numbers through
That's-
Lone Wolf,
That's awesome.
and that's the way. Whether it's on the buy side or the sell side, you're not going to be paying tax on that money that you don't receive. So that's the way we've done it many times over many years. So.
Yeah, that's amazing. I don't think it's a requirement here in Ontario, and depending on the brokerage that I speak at or the board, it would have a range of options available.
Yeah.
And that's why I have like cash there, check there, as well. So if you give cash, try not to give cash, because cash is not traceable.
That's your baby if you do that one. So
Yeah.
I don't know anything about it. So.
Yeah, so if you give cash, there is no record, no paper trail, and if you claim it as a deduction on your personal tax return, you may get audited, and if you ever get audited, then how do you provide the proof? And there are many realtors that went through the court case. I do get court cases delivered to my inbox, and there are cases that are based on realtors saying that I pay cash for these things. not just for referral fees, but cash for different things, and I'm claiming putting them through. But you're technically, as long as you can prove the payment, you're fine. So get a receipt. If your client is reluctant to give you an acknowledgement, you need to, as a minimum, and insist on collecting cash, as a minimum, you need to create that documentation yourself, send the email to them, hey, just confirming I'm dropping off this $10,000 referral or $5,000 or $1,000 referral fee to you this afternoon. So you can create that type of documentation. Now, is it perfect? It's not. The most perfect way to do it is through the brokerage directly.
RICO says that if you make a promise to a client, a buyer or a seller, you put it in writing, you give it to the brokerage, and whatever that amount is, you've agreed to it, and that's how we do it. So that when Sophia does the checks out, she'll do the check to yourself, to the company, and to the client that we have the promise. And it is, if you do a promise, you gotta put it in writing. If you don't, you're breaking, then you gotta talk to Carole, right? Like, she's the RICO expert, so, just good common sense.
Yes.
And, it's worked really well for a lot of years.
Why wouldn't the referral fee in the hand of the taxpayer be taxable?
Why would it be taxable?
Why would it not be taxable?
Why wouldn't it be taxable? It's just how it's being taxed.
Yeah.
I'm not saying it's not taxable. So there's no immediate tax implication if it is rental property. If it is a primary residence, so let's step back. The way it works is that, let's say you give out, I just use $10,000 because it's easier. Help the client purchase a property, $510,000. You give back $10,000. So that property is now really costing them $500,000, right? So that $500,000 is used for calculation of capital gain eventually, but they're not going, because it's related to the sale, it's used to offset against the purchase price. But you're not going, the client, unless they sell it immediately, they're not going to realize and have that tax implication until maybe 10 years from now when they sell the property. And that's why there is no immediate tax implication.
What if it's the primary residence?
So same calculation, if it is primary residence, assuming that the client has used the property, will be using the property for primary residence for 10 years, the next 10 years, and always use it as primary residence. That's the simplest case. Again, the $10,000 is used to reduce the purchase price. Now the purchase price is $500,000. So then eventually when that client sell the property for $1,000,001, the capital gain $600,000 is non-taxable. That's why there is no tax implication.
There's no taxes on your primary residence and your personal residence, so you bought it for $500, you sold for $2 million, the 1.5 is tax-free. One of the best things to do is, only for residential and your primary residence.
Assuming you use it for
Yes.
all
Yes.
primary residence for,
Yes.
Well, let's just change it just a
Sure.
little bit. So a neighbor gives you a referral for his next door neighbor. So it's individuals you don't know, and you agree to pay that neighbor that gave you the referral, say $10,000. So you get everything in writing.
Yeah.
That neighbor gets $10,000. Tell me why that isn't taxable.
So I'm not saying that in that case. So we have always been talking about under this referral fees you're paying through your clients. Now, if you're talking about paying your neighbor, which is in violation of RICO's rules.
I got my flyers ready.
I wasn't prepared to
Mike,
do
use
that.
the cash, Mike, use the cash.
No, so so sometimes you do have clients, you do have third parties that provide marketing service to you or consulting service to you, and they issue a consulting invoice or marketing invoice to you, and you're happily paying for the marketing and consulting service, then that is taxable 100% in their hands. They probably need to charge you HST if they have a business of doing it. So depending on what they do for you, referral fees we don't recommend, but marketing fees and consulting fees, and provided that invoice are provided, then
One of the things I'm running into as an agent is, I think writing deductions is not that difficult. I think we have enough deductions to bring the income down. But then when we go to the banks to get mortgages, it's either we pay a tax and be qualified to get a mortgage, or if we bring the income down, then you go to the bank, you can't get a mortgage. So what is the best way to kind of, what would be the best position, and how would you go about doing something like that?
So,
Make more money.
But you pay more tax, right? But getting the deductibles is easy, but what is the way to get around that?
So, a couple of things. Like the last couple of years have been a little bit weird in the real estate brokerage, like realtor world, because you're transitioning. A lot of my clients are transitioning from being a self-employed T1 individual to having a prac. So by earning all your income in the prac, you're only paying 12.2% tax. So you can shelter as much as possible in the prac. And if you work with, I think a lot of us would have connection with mortgage brokers. I work with a lot of mortgage brokers. You have to really work with someone that knows your business and that can really work with you. And who's mortgage brokers here?
No.
Okay. I'm not going to piss anybody off, right? So, majority of the mortgage brokers don't understand the business side.
Mm-hmm.
So I found that for me personally and for a lot of my clients, you have to approach the bank directly. So there are, like historically, because I have been working in this field for a number of years, not quite 10 years, but a number of years, and I've been always trying to find financing for myself for investment purpose. I found that the bank actually work with corporation directly. They actually look at your financials. And they also look at your incoming. So you can't qualify for A lender necessarily the first couple of years. You may have to use B lender. And over time, last year I purchased 2 Hamilton duplexes. I use B lender. And when I use Home Trust, they only look at the incoming income to qualify you, okay? And that's using my business income. Doesn't even look at my payroll. And I have a huge payroll. And then I have, last year I also switched over to Scotia Wealth. It's private, I guess it's private banking they call it. It's like $120 a month. It's not substantial amount.
Yeah.
They don't lend 80% loan to value. They do 65% loan to value, but it's interest only.
Okay.
And you qualify under those programs. They like to work with you. You have a large asset base. And other thing that helps, I found, and that's what I was told anyway, was whole life insurance.
Okay.
So investing through your whole life insurance, and then you have that asset that keeps accumulating, and you can use it as a collateral to qualify for more mortgages.
Okay.
And then the last thing is really just talk to the bank directly, build that relationship. I know HSBC are willing to lend directly to the corporation and really look at your situation. Scotiabank, National Bank, but a lot of the independent mortgage brokers would not be willing to do that work, and it's a lot of work. Don't get me wrong.
Yeah.
The banks just choose not to work with these mortgage brokers. I'm sorry, I'm off topic here.
Yeah. And one more thing, sorry. The other thing is a lot of us have home offices.
Yeah.
So when we're filing our taxes, we file, a certain amount of our expenses, trying to reduce our expenses.
Yep.
When we go to sell that property, how much of that is going to implicate tax?
Right.
So you want me to go through that question first?
If you can, yeah. I think everybody has a home office, and we're all telling our accountant,
Okay.
yes, I'm working at home.
So to qualify, I think home office is somewhere, to be honest. Maybe it's not here. Oh, it's not here. So what happened with home office is that there's a criteria that you need to meet. Is that it is the only office space that you have. You operate more than, I think, 50% of the time out of your office. So you need to meet that criteria and to be able to establish that. And then assuming you qualify to claim that, you can claim your home office expense really based on the size of the room or the number of rooms available. Similar to auto law, you have to keep a floor plan. So if you have a dedicated home office space of 1 bedroom, which is 100 square feet, your whole house is 2,000, so 5% of all your expenses would be tax deductible. Now, you can totally claim it, but here's the I wouldn't say it's a problem, but here's the reality. Some of us like to do house hacking, so meaning that you also rent out your basement, and then you also claim your home office expense. Now, to qualify you to claim primary residence exemption on the property that you live in when you sell the property, you would have to primarily use it as your primary residence. So there's no direct percentage specified in the Income Tax Act. So what's primary? Let's say it's very simple, you don't rent out your anything, you don't rent out anything, you use it only for your home office, and that's the only non-primary residence use that you have. That 5% claim, totally fine, would not affect your primary residence claim. But if you're claiming 1/3 of your house, then CRA may come back to challenge you and say, hey, like you're claiming 1/3 of your house, that's significant amount. But what's primary? There is no court case that would say one over another at this moment. If you're claiming 10%, 15%, I think it's pretty reasonable, but it's really going back to your floor plan, which room you're using.
So if you claim that 5 or 10%, so when you go to sell your home,
fine.
you're fine. There's no implications.
Yeah.
Okay.
Well,
And then, sorry, one more thing. And then now, a bit on that same note, if you have a basement apartment, which is, let's say you've got a bungalow, it's almost 50%.
Then that would be problem.
So you're primary and you're just renting out the basement. So where does that fall in?
Well, then if you have a basement, then basement is already 50%, depending
Let's
on
say
how.
forget the home office.
Yeah,
forget
then
the home
I would
office.
forget the home office.
Yeah.
But if you rent out the basement, they could still argue this is substantial. I would still file.
Yeah.
Like depending on how much you claim, because on your personal income tax return, you would report how much of it is personal
Yep.
use. You would want to make that number 60% and up
Okay.
as a minimum,
Okay.
right? Because then, if it's 50%, then it's equal. That's for sure significant.
Yeah.
But if it is under 60%, sorry, if its rental portion is under 40%, you can still try to argue. Again,
Okay.
it's up to the interpretation of the court judge. There is no right or wrong answer.
Okay.
Now, if you have a separate legal basement, you've gone through the process, technically it's a separate unit. If you've gone through that process, technically, even if you claim 40%, you will have to pay capital gain on that 40%. Okay? Question?
I was just gonna say that there's a capital cost allowance on the building. If you claim the capital cost allowance, then it becomes taxable when you sell,
Only for the rental portion of it.
only for the rental portion.
Yes, absolutely.
Or the portion that you're claiming for your office.
Yeah, but I guess because I just kind of take it for granted that we never put in the CCA claim at all. We don't do that. Yeah. Thank you. Yes.
I heard that it's 10%, but that was a long time ago. That 10% is the max for a realtor. I heard it through TREP, I think, but it was in a conference long time ago in the first brokerage, almost like my first day as a realtor. That if you want to have a home office, it will be 10% maximum to keep under the radar and to don't create any tax effect.
Yeah, this is the reason why I said at the beginning I can't be responsible for anything I say here because everyone's situation is different. He just gave an example that if you rent out your basement, 50% is already rented. And then upstairs, you use another 10% for upstairs, and now all of a sudden you're.
So 40-60 wrong way.
Yeah. So it goes back to your particular situation. Yeah,
Okay.
can't say it's 10% for everyone. In that situation, I would not claim home office expense. What's the point?
Yeah.
Right?
Yeah.
Yeah, you want to stay under the radar. Okay, so the rest of the stuff is pretty straightforward, obvious. You're advertising your website and what else? What other expenses? You have conferences, you would be able to claim it if you go to real estate related conferences. If you do, your office assistant would be tax deductible if you have an assistant. Sometimes people ask me if assistant should be a subcontractor or employee, then that depends on how much control you have over the assistant's work. The decision is you won't get in trouble until you fire that person. Let me just put it that way. You
fire them.
fire that person. Yeah. So then that person thinks that I'm an employee and go to EI and claim employment insurance, and that's when you would get in trouble. So apparently this is very common as well. So be prepared. If you are not prepared, if you want to be conservative, and you have a lot of control over the assistance day, then it may be more beneficial to keep that person as an employee. But then that means you have payroll obligation. Now that person, your employee, would still be eligible to claim home office expense or like whatever expenses that they have to incur to earn that employment income. You just have to create a piece of paper to show to CRA that they are eligible to claim all these expenses. So the last thing that I want to mention is, let's see, I think I'm running out of time. Medical expenses. So medical expenses, typically you get a medical tax credit. So do you guys understand the difference between tax credit and tax deduction?
No.
No.
Okay. So tax credit is calculated based on the bottom. Tax credit is based on, well, let's go back. Our Canadian personal income tax system is a progressive tax system. So meaning that if you look at the chart in front of you, it's not very clear, but between $0 to $13,000, which is the personal tax exemption, that amount is not taxable. There's a small amount to be charged by the Ontario government, but let's just say it's non-taxable. Now between $13,000 and the first $46,000 there is taxed at 20%. That's the personal tax rate. So you take 46 minus the 13,000, the delta of $33,000 multiplied by 20%, that's what you would have to pay, okay? Now, and then if you make, let's say you net 150,000, so you deduct all your expenses, you net 150,000, you actually have to go through the entire chart of calculation, take the difference between each marginal tax bracket, and multiply by the corresponding marginal tax rate to come up, and add them all up to come up with the tax. Now, tax credit, we all know tax credit, you get personal tax exemption, you get like medical tax credit. Tax credit is calculated based on the lowest tax rate, which is 20%, okay? Tax deduction, such as RSP, or any expenses that you write off, is being deducted from top line. So if you net 150,000, and you contribute $30,000 to RSP, that $30,000 is going to save you 43% of tax. So you always want to call something a tax, an expense, a tax deduction, rather than a tax credit. Now going back to because tax credit is only 20%, tax deduction is from your top line. Unless your net income is only $46,000, less than 46. If it is less than 46, there is no difference, right? Now, here's with medical expenses that you have. If you work for someone, you will have medical insurance, and some of them will be covered. But if you are self-employed and you own your realtor business in your personal name, you would have to claim your medical expenses as a tax credit. There's no way around it. But if you have a prac, you could be self-insured. So you could have this thing called health spending account being set up with your prac. The way it's being set up is there are lots of online options to set it up. You pay them a 5% fee on top of your expense. So if you spend $100 at the chiropractor service, that $100 you pay for it first, and then you submit the bill to this health spending account administrator, and then add 5% on top of it, and then they keep the 5% and they would deposit that $100 to your personal account, and then that $105 is being deductible in your prac as a gross expense. So it becomes a deduction in the business rather than a tax credit in your personal name. So it becomes more beneficial and become a tax write-off in your tax return. So it's something that I think everyone should look into. But if you have your business in your personal name, it wouldn't work, because it's just how the rules are written. This is not allowed. Okay?
You have to incorporate, and then you'd be able to do that.
yes, unless you have employees and arm's length employees in your business.
Right.
Yes. If it's just you and you, then unfortunately you have to incorporate. Yes.
Is the amount that is then paid to your account to cover your expenses, say for the year it totaled $1,000, is that now a taxable benefit for us personally? No.
It is like a self-insured.
Okay.
Okay. So I think we have 1 hour, right?
Yeah.
Yeah, okay.
Whatever.
So it's and then I mean the last thing is you now know that our tax rate is so high. This is how we calculate it. We really go through all the calculation, calculate the difference in each tax bracket and multiply by the marginal tax rate to come up with your tax payable. Now the reason why I showed this is because in corporation, if you haven't incorporated, the PRAC is only 12.2% tax. So if you look at 12.2% tax, like pretty much everything is over 12.2% tax. Now, but the corporation in itself is considered a separate legal entity. You have to file a separate tax return, and when you draw money out, you still have to pay tax on it. So it makes it's a great vehicle for you to save and invest in the corporation because you don't have to. You pay 12.2% tax in the corporation, and you keep a large chunk in the corporation. And when it's rainy days, and to some of my clients recently, we had conversation with quite a few of our realtor clients. They're not doing as well as last year. So with a PRAC, you can essentially pay yourself dividends, a fixed amount of dividend based on what you need, not necessarily based on, hey, the PRAC has 100,000, I'll take out the entire 100,000. It's based on what you need. You may only need 60,000. So then you save that extra $40,000 for next year. And because that $60,000 is being taxed on this tax bracket, these tax bracket, it could provide, you're essentially splitting income with your future self. So it could provide funds for you to save up for you to save for rainy days. Another benefit is the medical expense we talked about. But if you spend everything right now, if you make 100,000 and you spend the $100,000, there's nothing left, then there is no point setting up the corporation.
Yeah.
Okay? It's only for tax deferral purpose. Okay? I'm not saying that it should be for everybody. It really goes back to how much you make. It's a formula between how much you make and how much you need to spend. So that pretty much is my presentation. I have a lot. This was my Sarnia presentation, Sarnia board's presentation. I use a calculation to show you the reason, but in a nutshell, that's what it is. So I wanted to save like 10 minutes for questions if you have any questions. Oh, yes.
Sorry, for travels, like I went to Dubai and I met some developers and I stay like 10 days in hotels, and so can I write this off or no?
So is there a business reason for it?
Yeah, business in the same time.
There was a court case. It's this guy called Guy Liberté, who's the owner of Cirque du Soleil. So does everybody know Cirque du Soleil? Do you know Cirque du Soleil? Cirque du Soleil are those circus, yeah.
Okay.
They're circus, and then there are performers on stage that do like swing back and forth. Okay, so he's the owner. He's the one that created all these worldwide. He wanted to go to space. It's his childhood dream to go to the space. So he had his holding company pay for that expense. And then later on, he realized, hey, my holding company doesn't have any business income to deduct. So then he had Cirque du Soleil, the subsidiary, the business operation, to pay for the space, claiming that there's an advertising component to it. It's increased publicity. We did it for all these reasons. And at the time Cirque du Soleil was opening the Russia arm, there's a Russian, I guess, circus going on, Russian show going on. And he claimed the whole cost to space, and obviously you get disallowed. And then he claimed whatever he claimed, and then the judge basically just said, hey, it's really based on the primary purpose of your trip. So the owner, Guy Liberté, went online, it's everywhere. And yes, CLA does have access to internet as well, and they do Google you if you ever get audited. So they would, he said it's my childhood dream to go to the States, and it's really public. And the court said, well, like the primary purpose of your trip is to fulfill your childhood dream. It's not for increasing the publicity of the business or what's the measurement, return on investment. Now, so to answer your question, if you meet someone that has that will do business with you or that has done business with you, then I'll deduct it. But if you haven't and there's no real estate conference that's happening there that you attended, chances are there is no case to deduct it. It really goes back to the primary purpose of your trip. Let me just step back and give another example. I'm going to Mexico next year for a conference that's among entrepreneurs, like a retreat. So I'm going there, and I think that's the primary purpose of my trip. The hotel flight would be deductible. Now my family may tag along for a few days early. The cost of my family, so the flight, the hotel, for those few days extra is not tax deductible for my kids. My flight would be tax deductible. My hotel for the few days of retreat would be tax deductible. But my kids and my family's cost of hotel, food, and also flight would not be tax deductible, even though my primary purpose of the trip is tax deductible. I don't know if that answers your question.
Thank you.
You have to have that sequence of events also matter. All right.
John,
Yeah, I have clients that it's a primary residence, and now they want to add to their children's name on title. Is there any tax implication on that?
Yes. So like not immediate.
Uh-huh.
So depending on why the reason and the intention of adding the children's name on it, it makes a difference if they're being just added for the purpose of dealing with paperwork down the road, but the true owner are still the parents. That's called beneficial relationship. So the children are only on title for the purpose of really dealing with paperwork, and so the true owner are still the parents. Then there needs to be a documentation to show that the true owner is really the parents. Now, why does it matter? Because if they add the kids and essentially there is a deemed disposition because they're a related party, they are saying that it's deemed disposition of the property. It's primary residence. There's no immediate tax implication. Now, 10 years down the road, the parents are still alive, and the kids have been on title for a number of years now. The property probably have appreciated a ton, and then at that time, if the parents want to sell it to a third party and the two kids are not living in the property, they cannot claim primary residence exemption on their share of on their ownership percentage of the primary residence. So that's when there would be issues. If the intention is to have the kids owning, really just doing paperwork in case anything happened, then a trust document needs to be used to document that intention. So then later on, when the parents dispose the property, there is no issue down the road.
In this case, the intentions because the parents is getting certain age, okay?
Yeah.
And then in case the parent, was one is already passed, okay? It's only one left. So when that one left, okay, passed, then that means the two kids will automatically own the property without going through the probate, right?
Yeah.
So that's the intention, okay?
Yeah. So then I would rephrase your intention. The intention is really to have it only in trust for the parents. So then document that.
But does one of the children still have to live in the house? Is that what you're trying to?
If you have the trust document, then the kids don't have to live in the house.
Well, right now they're living in the house, and the
Well,
intention
then that's
that
fine.
That's better, right?
Yeah, that's better.
they will never want to sell the house unless later on these two children is gonna split, right, and decided to sell the home,
Yeah,
right?
then that's fine. If they're
That's
living
fine.
in, then there's no
They are
issue.
living there, yeah.
Yeah, they can use their primary residence exemption on that house.
Okay, now there's another second question. The parents own the title with a child, okay? It's been only for a long time. Now, the parents want to get off the title to let the child own 100%. The child has been living there as a principal resident. Now, when the parents want to get out, is there a tax implication?
You have to.
When they bought the house, okay, the parents put up the money, and the parents go on title with the child, and the child has been living there, but the parent never lived in that house.
So these are very specific tax situation.
Right?
I typically do not answer broken telephone questions
Okay.
because I can't ask more questions to clarify. It really goes back. You mentioned that it goes back to the initial down payment and initial intention. If the initial intention is that the parents are buying it for the kids to live in, and there needs to be documentation.
I see.
If there is no documentation, CRA can come back and challenge you when you remove the name. And how do you document that when the initial down payment is really from the parents?
Right. Yeah.
So then it goes into a bunch of gray area that how much your client is willing to take versus what kind of documentation has to be created right now to document that intention. So
I think John needs
Okay.
your card to give to his clients so they can call you. How's that sound?
Yeah.
Okay.
Yeah.
Thank you. Yeah.
Anybody
So
else?
it's a little bit more complicated.
Yes, well, it's
Yeah.
just to have the advice of this young lady,
Yeah.
so, or some lady, somebody.
Yeah. You have questions?
No,
No, you're good?
Actually, I have a quick question.
Sure.
Is there any advantage of transferring a personal property into a corporation, or no? Is there just it's better to have a primary? And I'm just saying it because you mentioned that you personally have investment properties.
Yeah.
Like from that perspective of purchasing multiple
Yeah.
investment properties, is there any advantage or no?
So it depends. Do you have a prac?
Yeah.
So then that's where your advantage comes in from. If you have a prac, then you're paying 12.2% tax. If you pull the money out to your personal name to buy your rental properties, then you will have to pay another layer of personal income tax. But if you leave the money in the corporation and transfer it to a real estate investment corporation to invest, you don't have to pay another layer of personal tax. So that's why you would want to invest in a corporation for yourself.
But your personal property has that layer.
What do you mean by personal properties?
Like your primary
Then there
residence.
depends. I have clients who want to sell their primary residence into the corporation because there's a large amount of cash sitting in their professional corporation. Those are doctors and dentists, and so they wanted to sell it in to retract money out. Typically, I wouldn't recommend putting the primary residence into the corporation.
Okay.
Now, if you have multiple rental properties, that's a different story. If you have that long-term outlook, you want to hold those properties long-term, and you're having challenge getting your mortgage, by putting them directly into the corporation, I found that the bank usually ignore the mortgages that are held in the corporation when they qualify you. Now, this is experience. I'm not saying that, hey, I guarantee that. Nothing today that I said is a guarantee and advice, but we found that you can become a mortgage virgin all over again if you have all your rental properties in the corporation and the mortgages are registered in the corporation.
Oh, interesting.
It's a long-term deal, but it's a very beneficial deal for someone that's making really good income. If you're making $150,000, $200,000, $300,000, $400,000, you set up your own company, and as long as you don't take out the $300,000, which you're going to be taxed on personally, but if you take out as little as you can, you're building your nest egg in that as your investment vehicle.
Yeah,
And that's
exactly.
what you're basically saying.
Yeah.
And sorry, one more quick question. So my prec is fairly new.
Yes.
And in my account that I have all like my commissions and everything come into, it's separate from like my joint account and
Yeah.
so forth. Would there be any advantage of moving that money into my prec, or no, there's no advantage there?
So if you already have a prac, I assume that all your
Like it's a brand new prec.
yes,
there's-
your current so you have a prac. Technically, you sign the agreement with the brokerage. You're operating with your prac, and then the commission should go into from that point on should go into the corporation.
But past commissions moving
Past
into
commission,
the,
there is no.
there's no okay, advantage or anything like that.
You have to pay tax on it, save it for taxes.
Okay.
At the end of the year, yes.
Hi, if you have an investment property that you're wanting to purchase outside of Canada, do you have to file taxes in that country for that investment property, or can you file everything here? And if you can give me some more information about buying an investment property outside of Canada.
Where are you planning to buy?
Portugal?
Okay, so I don't know it well enough to tell you, but typically, typically, the country that you purchase the property in, they would have their own withholding tax that you have to pay. You have to file a non-resident tax return there, assuming that you are using it for investment purpose and rental purpose. Now, if you're just using it for your own personal use purpose, there is not, chances are there may not be any filing requirement, but you have to talk to someone local. Now, the second part of it is that if you own that property, say in your personal name, then you report you would have to report the income on your personal tax return. And there is also something called 1135 foreign property reporting requirement that you have to file. You may want to, some people want to consider setting up a corporation, but just because you set up a corporation in Portugal, doesn't mean that you don't have to file taxes in Canada. So CIA still wants to tax you on any foreign corporations that you own. So, but if you own it personally, it's the simplest form. You put the money, you have to report that 1135. You still report the rental income and expenses. Any income tax that you pay in Portugal, chances are, depending on the treaty, you may be able to get a credit back on your Canadian tax return. So you pay less amount.
Thank you.
Once you take income, like I have a property in the United States, but I don't rent it. So basically, I've sold a couple of properties, they hold a withholding tax, and you have to prove to them you didn't make any money or very much money on it, then they give you back that 30%. So now I'm sitting in a nice condo, paid for, but I don't rent it. So I don't have to report anything to the United States or to Canada, because there's no income coming from it.
Until you
But
sell
once I do something,
Yes.
like once I sell it and I make a profit, then I gotta report to both Canada and the United States,
Yes,
correct?
yes, absolutely. Mhm. Question?
What's a CrossFitter?
Oh, CrossFit is a cross-functional type of gym that
Okay,
you do.
alright.
You do a lot of weightlifting and strength training,
Okay.
and then the workout typically like 10, 15 minutes, 20 minutes long, but it combined with weightlifting, and so it's really tough.
Just one question on entertainment expenses. You know, I understand the 50% for meals, okay, and entertainment obviously falls under that as well. Is there any way of justifying entertainment expenses as advertising or marketing, which would be 100% deductible?
Bring a pop-up banner with you.
No.
No?
I can't, give me a scenario, I mean, if you take someone to the restaurant, have a group of people, a group of your clients, but you're still paying the restaurant bill.
Yeah. I'm not really referring to meals, okay,
Yeah.
more so for entertainment.
Yeah.
If you, at Christmas as an example, okay,
Yeah.
if you buy 50 of your clients, a $10 bottle of wine. All right.
Yeah.
So that would be classified as entertainment
Mhm.
as opposed to advertising or
Yeah.
marketing?
Yeah.
Okay, so, but
Don't
you
buy the
can't rationalize that as an advertising or marketing expense?
So wine specifically is
Mhm.
excluded, so it's
Okay.
not something that's more,
Gift
A
baskets?
gift basket.
yeah,
Gift
gift
Yeah.
basket, but would be easier for deduction. So
Mhm.
wine is just because it's alcohol, so it's specifically
Okay, all right.
mentioned.
So it depends on the product. somehow,
Yeah.
right? Yeah,
Yeah.
okay, all right.
So you're 100%, I like what you said, so if you did a Home Depot,
Yeah.
or you did, what was the other one you said?
Amazon.
Amazon.
Amazon, is there a couple other companies that you might
What
be
about
in
Home
that
Sense?
category? That you can think of?
HomeSense is fine. Yeah.
100%?
It's not.
Not food or drink,
No food or drink. Yeah. No entertainment.
no movie, no
I did a
theater.
gift card for Canada. Would that be considered marketing or would I consider like a travel expense or something? I took it as 100% marketing.
You classify whatever you want.
Until you get audited.
Yes. Yes. Yes.
If he got a custom label printed for a bottle of wine, for example, with his name and
Yeah.
roll the page and all that on it, would that
It's still a
not?
bottle of wine though.
Is that okay?
Yeah. Then you may as well just give like an engraved.
Pen
book.
or something.
Yeah.
Yeah. Do they finish to be honest, if they finish drinking it, then that's the end of it, right? But then your notebook lasts for a long period of
You
time.
have a lot of.
Or swag, any swag.
She's got the technical, yes, mostly.
I know this from credit cards that I collect a lot of the points on them, so I know a lot of the hacks on the credit card points.
Good, which one should I get?
I recently just got the Amex and I'm loving it so far. Before that I was using Scotia,
Uh-huh.
but with the Amex I get more points with gas, grocery, and drugstores. So if I go to Shoppers and buy a Shoppers gift card,
Yes.
could that be then deducted? And then with that Shoppers gift card, I could buy an LCBO gift card in Shoppers.
Can you buy a gift card with a gift card? I thought you could do that.
Yeah, you can.
Yeah?
I don't know.
I
on
actually-
Amazon, actually, Amazon, you have options to buy gift cards.
Yeah, and I do that with my gas all the time. I buy the gift cards either at the gas station or at Shoppers, so I get double the points on my credit cards.
Oh, okay. Oh,
Yeah.
I see.
But
Now,
I'm saying
so-
for alcohol, you could buy the gift card.
So, I have to cut off in like 5 more minutes. To answer your question, the answer is no. Like you have to remember. I don't know if you saw. Like you actually have to document who you give the gift card to. But for tax deduction purpose, like for your points, that's completely separate. But for tax deduction purpose, when you go to Shoppers to buy a Shoppers gift card per se, you have to document who you give that Shoppers gift card to. You didn't give it to anybody. You give it to yourself. You use it for LCBO.
Right.
So then they would say, okay, you did. Then that on its own is not deductible. So when you redeem the gift card, then it's to pay for the LCBO. The whole thing is not tax deductible. Now, how likely are they going to notice that?
Right.
I can't tell you. But technically speaking, it's not deductible.
You can always lie, say you
That's
give me
right.
one.
I actually did that last year. I bought Tim
Yeah.
Hortons gift cards from Shoppers.
Yeah.
And I just bought a bunch of $25 ones for our Almanac and then like a
Yeah.
Christmas card kind of thing. But I just submitted the Shoppers receipt, but it did show like gift card, gift card, gift card, gift card, like Tim
Yeah,
Hortons,
yeah.
It says Tim Hortons on there or
It'll say,
logos.
it'll say like I don't remember what it says, but it was just like,
Yeah.
and I submitted that
Yeah.
to like CRA. So
Yeah, it's
I don't know the depth of how much my accountant used on
Exactly,
it, but
yeah.
Food and
that was just.
yeah. If we see it, like as an accountant, I can tell you, we're not gonna go into every single detail. That's like Shoppers, okay, whatever. But at the end of the day, if it is really Tim Hortons per se, and the receipt on its own says Tim Hortons, then
I actually didn't know that you weren't supposed to do like.
No, I'm just saying.
This is just like.
If you
news,
go
yeah.
all the way, how likely, I can't tell you, but that's the rule.
Yeah, no, fair enough.
CRA is wrong about that other thing, but you can't go up against them, right? Like when you said you gave $100
Yeah.
to somebody for a gift, as a gift card, and you can only declare 50%. They're wrong, but you can't go against them, right?
Yeah.
That's the bottom line.
Yeah.
It doesn't make sense in my head. Probably doesn't make sense in anybody's head in this room,
Yeah.
but that's the way they are.
Yeah, sadly, yes.
That's
I
the
always
problem.
tell-
That's the problem.
Yeah, I always tell people don't pay me. It's my message. I mean, I'm just trying to carry this message.
That's a good message. You gave us some other options like Amazon, Home
Yeah.
Depot, Lowe's. I guess Lowe's would be in that same
Yeah,
category.
yeah.
And there's a few other ones that would be in that category.
Do you want to mention quickly the conference you're having in November now?
Oh yes. Thanks.
No problem.
Thanks for the reminder. I'm having a conference. I'm hosting this guy. His name called Jesse Itzler. I don't know if you guys know Jesse Itzler. For the ladies in the room, his wife owns is the founder of Spanx.
Oh, yeah.
Yeah, so Spanx, Sarah Blakely. So Spanx was just sold for $1 billion.
What?
Wow.
So he's very rich. It's a lot more expensive to get Sarah Blakely to come. So and Jesse Itzler is actually a serial entrepreneur. He found Mahi Jet, which is a time card jet, kind of like timeshare for private jets.
Oh, wow.
So he found that company and sold it to Warren Buffett later on. And he also partnered up with Zico Coconut Water because he's a ultra marathon runner. So he partnered up with Zico and and helped Zico being sold to Coca-Cola. Yeah, so he's a very inspirational guy. And then the conference name is Wealth Hacker Conference. We are just going to go through different types of wealth hacks available, including like different type of investment vehicle, like real estate for sure, and then we have stock as well as whole life insurance, how to use whole life insurance, and then I'm going to talk about 5 steps to retirement financial freedom. So it's a little bit different from my usual tax talk, but that's what I will be talking about. There's a little bit of economic update because the economy is going crazy right now. So yeah, if you guys are interested, go to wealthhacker.ca, or if you follow me on Instagram or social media, I'll be like.
When is the conference?
November 12th, Saturday.
And where is it?
Is at really close to here, Toronto Congress Center.
Oh yeah.
Yeah, it's like just.
You mentioned whole life a couple of times. Do you think it's a very underrated vehicle that we don't take advantage of?
Yeah.
Right, like insurance as its whole, if you really understand insurance, right?
Yeah, so I have a bunch of whole life insurance. Like at the beginning of last year, because one of my clients sell whole life insurance, and then he came to me and said, "Oh, this is great." And at the time, I just bought my office condo, so I'm like, I need life insurance because I have this whole 100% financed office condo that I own, and if either my husband or me pass away, it will be a huge problem. So it's just very timely match, and then I committed to buying it, and then I started doing research. It's not very smart of me, but the more research I did, the more attractive it is. You do have to put a lot of confidence in the insurance company, but they have been around for hundreds of years, so it's as good as a bank. What it does is essentially you buy a whole life insurance policy, you buy an insurance policy, and there is a component that goes into the insurance side because you're being insured, your life, there is the death benefit. There's a component that you pay that goes into this cash deposit side. So that cash deposit side will keep growing at a percentage every single year.
Roughly, what are you seeing in returns when you did your research?
I was told about 6%.
6%.
But then the whole thing is tax free.
Okay.
Right?
Even on the income, on everything that is building.
In the policy.
Yeah, I know with the payout benefit is tax free.
You can draw that dividend out tax free when you're older.
Okay.
When you accumulate enough to draw out.
Yeah.
So then the math works to be tax free.
Okay.
So you can draw some money out tax free, or you can borrow against it.
Yeah.
Which then you can just essentially by the 5th year, whatever you put in, you would be able to take out as a loan. And if you use the money to buy investment property and earn income that is tax deductible, you have a whole life insurance that's growing in value and growing tax free for you, as well as having a property that's growing tax free for you.
That's if you take that money and put it there. Yeah.
The interest is tax deductible. You take it as a loan.
Okay.
So your whole life insurance policy is an asset. I mean, we're going to talk about all that also at the conference. But yeah, so.
Actually, I ended up buying policies after I saw that presentation.
Oh, you saw the presentation?
Yeah, I have my kids and one.
Yeah, I have my kids as well. It's only $5,000 for the kids, so it's not that lot. Yeah.
Is that whole life policy like that universal life? Because I have one of those policies. when I was
So
younger.
the one that I have is participating dividend whole life insurance policy, which contractually they need to increase our cash surrender value every single year, regardless of what they do. Sometimes it's higher, but like they contractually are required to increase that value. Universal, depending on what the underlying investment vehicle it is.
Yes.
So it's not necessarily contractually increasing.
Right.
Yeah,
I had
so
to pay
that's-
an extra couple of years on it, but
Yeah.
that set fee, so then that set fee, say 250,000,
Yeah.
you'd be able to use that as to help you with buy an investment property.
Yeah, yeah.
That's a collateral.
Yeah.
Two things, yeah.
Depending on the policy.
Yes.
But I'm not a life
Yeah,
insurance.
yes, no,
yeah,
I'm
so-
not either, so.
But
Which
that's all.
company is yours with? Just out of curiosity.
Sorry?
Which company is yours with?
Mine is with Equitable.
Because I see like Sun Life and Manulife are starting to do those.
Manulife just re-entered the market a couple years ago. Sun Life has been around. We looked at Sun Life policy compared to, say, the return on investment. It's not as high as Equitable, and Equitable is completely mutual. So like the policy holder actually owns Equitable. But Sun Life as well as Manulife, they have shareholders, so they work for the shareholder. That's the idea.
Okay.
No, how much do I know? I think I know more than average people, but I don't know it well enough to.
I've been thinking to somebody about it. It just seemed a little bit over my head, so
Oh,
it's
yeah.
nice to hear that.
Do you have some business cards we can hand out?
Oh, no, I don't carry business card. That's my business card.
Huh?
So that's gigantic.
Yeah, thanks very much.
Thanks so much.
Thank you.
The best is don't run any-
Feel, believe it, hand me
I
a
know.
call.
Yeah. You don't have anything, you